Hey, hello, welcome friends. In this video, we are going to discuss about hedge accounting in financial statement unit 6. So, what is this hedge funds? Why we need to discuss and how we can disclose in the financial statement. These are the concept we are going to learn in hedge accounting. So, firstly, the hedge accounting in, for example, in investment banking, the fund accounting we have mainly focus on three funds. One is mutual fund, one is private equity fund, and another one is hedge fund. So the last one is hedge funds. So this hedge funds, what they can do now, hedge funds, they will pull the money from the investors. That investors will be accredited investors, or this HNI, that is high net worth individuals. They will get money from that persons and they will invest in different assets. They may invest in any asset, they do not have any limit, and they will get the profits and they will share the profits to this HNIs, that is high net worth individual persons. Here the main aim or main objective of this fund is whatever the market may be bullish or the market may be bearish. So whatever the market position, you want to get the profit is the main motive of this hedge fund. So what is there here? The objective of hedge fund accounting is to represent in the financial statement to effect an entity's risk management activity that use financial instrument to manage exposure arising from particular risk that could be affect profit or loss. So they will take some decisions. Now it is also using as a risk management tool. This is hedge accounting. Whatever the instrument they are using, whatever the exposure they are managing, whatever the particular risk they are arising, they need to disclose in the financials. So whatever affecting the PNL, they need to provide here. So in PNL we have two, one is profit and loss account and another one is other comprehensive incomes. So in case of it is related to equity instruments for the entity, then they need to choose that fair value of OCI. We have FET PL, I think it is FET PL, FET OCI, FET amortized cost. So when it is relating to equity, then we need to go with the OCI. An entity may choose to designate a hedging relationship between a hedging instruments and a hedged item. So that is hedge accounting. So when you are relating to hedging relationship or you are using hedging instrument, then it is known as hedge accounting. Here the hedge accounting means it is one option provided to qualifying criteria are met. So if the qualifying criteria are met, we can use this option, and in such a case accounting for gain or loss arising on the hedging relationship, that is including hedging instruments, and hedging instruments shall be accounted in a specific manner as detailed further in the unit in order to avoid measurement and recognitions inconsistency which may arise otherwise. Here what is there, a stepwise analysis will be there. Firstly, step 1, we need to identify the hedge items. So what are the items we are using? Among the items which are the hedge items, we need to identify that is exposed to one or more risk. So here the hedge accounting risk will be high, and because the aim is also big now, so because of that they have more risk, they are trying to get more returns. And steps 2, identifying the hedge instruments. So firstly we are identifying hedge items, after that we are identifying hedging instruments. Here hedging instruments may be derivatives or non-derivatives to offset in cash flow or fair value of hedge items. After that, evaluate if hedging relationship needs to requisite criteria for hedging accounting. So we need to identify the relationship between the requisite criteria of hedging accounting. And step 4, if hedge are effective, establish the type of hedge. So in type of hedge we have three types of hedge. One is fair value hedge, another one is cash flow hedge, another one is hedge of net investment in foreign operations. So we need to identify which hedge is effective for the identified hedge. And after that, step 6, here I think step 5, okay, step 5, accounting for the hedge relationship basis guidance in India AS 109. So all financial statements are deal with three accounting NDIS standards. All in 109 financial instruments we need to recognition as per 109, that is relationship. So what we are doing in hedge accounting, firstly we need to identify the hedge items, after that we need to identify hedge instrument, next we need to hedge relationship, and for which effective hedgement, which type is effective, we need to identify fair value or cash flow or hedge of net investment in foreign operations. After that we need to guide relationship as per 109. Here hedge instruments can be evaluated single hedged items or group of items. So like in income tax we have block of assets na, if the similar asset is there, then we need to block that assets, so we need to maintain that block. Same like has this hedge items also same, if it is how same items, same characteristics, we need to group it multiple instruments hedging specific risk associated with the hedge item. So if it is relating to specific risk, then we need to group it. And here we need to identify the hedge item, that is step 1. So and designation of hedge items. Now hedge items means hedge items can be recognized, it may be asset or liability, and unrecognized from commitment or forecast transactions or net investment in foreign operations. So the hedge items can be, it may be single item or it may be group of items. So here hedge items can be also component such items of group of items. So here the hedge items, whenever we are identifying, it must be reliable, so then only we need to recognize. In India is I think 37 provisions, contingent liabilities, contingent assets. We need to identify it must be reliable, then only we need to recognize the liabilities. And there after the reliable, the hedge items are reliable, then we need to item the forecasting the transactions. So means by using the valuation techniques, by using the future projections, by using the provisions, or by using the discount cash flow method or comparative method, whatever the method we use, we will forecast the transaction. So what will be the transactions? Highly probable, and probable will be there. So after that probable, an entity may designate an item in its entirety or components of an item had the hedge items in hedging relationship. Here entity, firstly whatever the changes, it changes may be all changes relating to cash flow or fair value of items. So we need to compromise the entire item changes, and a component compromises less than entire fair value change or cash flow variability of an item. So in that case an entity may designate only the following type components. Firstly we need to identify what are the changes in cash flow or fair value relating to specified risk or risk components. What is the risk will be that we have different types of risk there: political risk, interest risk, credit default risk. So we need to identify the particular transaction which risk will be applicable, provided here based on the assessment, your assessment, based on that assessment we need to go with the particular market structure. In the context of particular market structure, okay, we identify the risk, which market we are there as of now, and what are the risk components separately identified and reliably measured. So we can measured. So firstly we have reliably measured, after that we need to forecast is probable, and we need to identify the entirety for the item relationship. So for that purpose of relationship, we need to see the what is the risk. For the risk, we need to identify cash flow risk or fair value risk. For the fair value risk or this cash risk, where that risk component is there na, for that risk component we need to identify and reliably measure will be there. So you are, for example, if you are identified there is interest risk, so in market interest risk, now from that interest risk we need to identify separately, means why interest risk is there, is it from banks or it is from the borrowers, it is from the market structure, or it is because of inflation. So we need to identify the specific on risk and his designation. So only changes in cash flows or fair value hedge items are above or below specified prices or other variables. One or more selected contractual cash flows. So for the purpose of, we have specific methods na, that discounted cash flow method is also there. So we need to identify the contractual cash flows and components, nominal amount and specified part of amount items. Now qualifying the instrument for hedge accounting and designation of hedging instruments. So this is hedging instrument, when will which will have hedge instruments. In hedge instrument we have different options, we can use derivatives also and non-derivative items also. So hedging instruments means derivative measure at fair value to P&L except for return option. If we have a return option, we cannot go with the FVTPL or non-derivative financial assets or financial liability measured at FVTPL. So all are measuring at FVTPL only. So it may be derivative or it may be non-derivative except return option. If you have return option, you cannot go with the FVTPL. All these hedging instruments. Some exceptions will be there to designation. Non-derivative financial assets or non-derivative financial liability has hedging instruments. Here a financial liability designated has at fair value through P&L, for which the amount of its change in fair value that is attributable to change in the credit risk of that liability is presented in the OCI. So if you are getting any changes here, changes relating to FVTPL, of which amount changes FVT fair value that attributable to change in credit risk. So if it is relating to, we have different types of risk na, credit risk, interest risk, inflation risk. So if it is relating to credit risk, you may present in OCI, that is other comprehensive income. So in, if it is relating to hedging foreign currency risk, so the foreign currency risk component in non-derivative financial assets or non-derivative financial liability, it also you can recognize in OCI. So normally we will recognize in FVTPL, that is profit and loss account. But in case of if you have credit risk or currency risk, these risks may you can choose for this OCI, FET OCI, and qualifying instruments must be designated in its entirety as a hedging instrument. Here for the instruments will have some exceptions are there. So what are that exceptions? So one is, we need to separating the intrinsic value and time value of option contract, and designation has the hedging instruments only change in intrinsic value of an option and not the change in time value of money. So when we are identifying one instrument, we will go with the discounted cash flow. In discounted cash flow, what are the inflows, what are the outflows, and we will use one rate, IRR rate, and we will maintain that amount. We will discount this, we will take and come into present value, it will become the value. This present value amount is also known as intrinsic value. So we will separate that intrinsic value and time value of option contract. So time value means we are discounting so we will take one rate and we will discount that rate, that is time value. We need to identify, separate that intrinsic value and time value of option contract, where designation of hedge instrument only changing in intrinsic value how much and not changing time value of money. And after that, for the separating the forward element and smart element of forward contracts, so for forward rate what is there, spot rate what is there, and designated in the hedge instrument only changes in value of the spot element of forward contract and not forward elements. So we need to see, if you are enter into forward contract, we need to perform in forward contract what will be there. So we need to enter one agreement, because we have uncertainty in the future, so that we need do not take much risk. We will enter in the contract as of now for the purpose of after 3 months or 6 months, whatever the contract period, at that time at a predetermined price and a predetermined date and predetermined quality, quantity, goods, how much quantity we will require, we will enter in this cases. So if you are changing any element, if you change quantity, it is not required to record. But if you are changing the contract itself, forward contract, from we are entered at 500 rupees, now we are changing the contract amount will be 600. So when contract is changing, we need to record. If it is changing just element, you cannot, it is not required to recognitions. And a proportion of entire hedge instruments, here 50% of the nominal amount may be designated in the hedge instrument in the hedging relationship. However, hedging instruments may not be designated for part of its change value that result from only portion of the time period during which hedging instruments remains outstanding. Here in regarding all are FETPL, but we are exception is there in derivative cases. One is return option. Here return option are not hedge instruments. Why? The derivative instruments that combines return option and purchase options. So for example, here interest rate collar is there, which does not qualify as hedge instruments if it is or in effect a net written option at the date of designation. The decision 3 to determining if an instrument can be designated as hedging instrument has follow. Firstly, we need to see whether hedging instrument is derivative or non-derivative. So firstly we will classify that instrument is derivative or non-derivative. For derivative, all are FETPL except return option. In non-derivative, all are FETPL, but for two risks we have options. One is credit risk and another one is currency risk. Now firstly we need to identify which is derivative contract, which is non-derivative financial asset or financial liability. If it is derivative, so it is there any net return option, we will see. If it is how net return option, it is not a hedge instrument, cannot be hedge instruments. If that does not have any return options, so then can be hedging instruments. And here non-derivative financial assets or liability. So if it is non-financial assets or liability whose fair value changes attributable to credit risk are recognized in OCI, or investment in equity instrument designated as FEC OCI. So we need to see if it is have any credit risk, if it has any currency risk, or if it is eligible to OCI, then we will go with the this one only. It is, if we are going for that, it is not a hedging instrument. If it is not, we will consider it as a hedging instrument. Now qualifying criteria for hedging accounting. So hedge accounting qualifying criteria. So what are the qualifying criteria? A hedging relationship qualifies for hedge accounting only if all, just a second, hedge accounting only if all the following criteria are met. If it is met all these following criteria, then it is qualify as hedge accounting. So first, hedging relationship consists only of eligible hedging instrument and eligible hedge items. So we need to see the hedge instruments and hedge items. So eligible items. At the inception means at the starting point of hedging relationship, the formal designation and documentation of hedging relationship. So we need to see the designation and we need to see the documentations and entity risk management objective and strategy. So what are the risk management and strategies will be there undertaken in the hedge, and the documentation shall include identification of the hedging instrument, the hedge items, what are the nature of risk being hedged, and how the entity will assess whether the hedging relationship meet the hedge effectiveness requirement. So here we need to include its analysis of source of hedge ineffectiveness and how it determine the hedge ratio. So now hedging relationship means all of the following hedge effectiveness requirements. So when we need to establish a relationship, so following requirement will be required. There is economic relationship between the hedge item and hedge instrument. So firstly we should have a economic relationship between the hedge items and hedge instruments, or effect the credit risk does not dominate the value changes that result from the economic relation. So we need to see the credit risk does not dominate. So if it has credit risk or currency risk, we will go with the FEOCI na. So the credit risk does not dominate. So firstly we should have economic relationship and credit risk does not dominate the value changes that result from the economic relationship, and the hedge ratio of the hedging relationship is the same, has that resulting from the quantity of the hedged item that the entity actually hedges and the quantity of the hedging instrument that the entity actually uses to hedge that quantity of hedge items. However, here the designation shall not reflect imbalance between the weighting of the hedged items and hedging instrument that would create hedge ineffectiveness. Here, irrespective whether recognized or not, the good result of an accounting outcome would be inconsistent for the purpose of hedge accounting. Now we need to identify for the relationship now. If hedging relationship is there, we need to account that hedge instruments. So for entity applies hedging account if it is applied hedging account to that hedge relationship when qualifying criteria are met. So firstly we need to see the type of relationship. There are three types of hedging relationship. One will be fair value hedge, another one will be cash flow hedge, another one will be hedge of net investment in foreign operations. These are three types of hedging relationship will be there. For fair value hedge means here the fair value hedge is a hedge of the exposure to change in fair value of recognized assets or liabilities or unrecognized from commitment or component of any such items that is attributable to particular risk and could affect profit or loss. So for we have three types of there. So one is fair value hedge, another one is cash flow hedge, another one is hedge of net investment in foreign operation. For fair value hedge, the fair value hedge will have exposure change in fair value of recognized assets or liabilities or unrecognized from commitment or component of an such items that is attributable to a particular risk and could affect the profit or loss. So when fair value hedge meets qualifying criteria, fair value hedge shall be accounted as. So for fair value hedge we need to see the either hedge item is an equity or items designated as FEOCI. So all hedging items it may be derivative or non-derivative. If it is derivative we need to recognize any FETPL except return option, or non-derivative financial asset or financial liabilities we need to write in PNL FETPL except that currency or credit risk. So we need to see that one only. It is hedge instrument designated as FECOCI. If it is FECOCI, then we will then we need to recognize that gain or loss in the FOCI. Or if it is not FECOCI, then we will recognize in PNL. Or the hedging gain or loss on hedge items. So it is relating to equity, we need to see. If it is items, we need to adjust in carrying amount of hedge items. Now gain or loss compromises both hedging instruments and hedge items. So here hedging items, if the hedge item is a financial asset or that component is also a financial asset, then we need to measure at FETOCI. So FEOCI, we need to measure in FEOCI. Other than equity, the ignited FECOCI in accordance with Ind AS 109. Whatever the hedging gain or loss, we should recognize in profit and loss. So PNL will be used. Or when hedge items is unrecognized from commitment, so the cumulative change in fair value of hedge items subsequent to its designation is recognized as assets or liability with corresponding gain or loss recognized in profit or losses. So firstly, the hedge item is relating to financial assets. We need to measure at FECOCI. Other than equity instruments, if it is other than equity instruments, designated FECOCI. If it is designated as FECOCI, we will accounting as per FECOCI. Otherwise, it will be recognized as PNL. Or the hedge items, unfunded commitment is there, unrecognized firm commitment is there. So unrecognized firm commitment, if it is any cumulative changes in fair value, the items, the subsequent changes is happen, then it will be recognized in profit and losses. That is fair value hedge. After that, cash flow hedge. So in cash flow hedge, a cash flow hedge is the exposure to variability of cash flow. So what is the variability of cash flow? Which that attributable to particular risk associated with all or component of or recognized assets or liabilities. So such as all or some in future interest payments on variable date or highly probable forecast transactions and could affect the profit or loss. So we need to see what are the effect will be there for profit and loss account. Now whether where a cash flow hedge meets qualifying criteria. So if it is meet the qualifying criteria, it shall be accounting as follows. So firstly we need to see the separate component of equity associated with the hedge item. So what is the component associated with the hedge item? So if it is relating to equity, separate component of equity, we need to see cash flows of that hedge reserve is adjusted to lower of the following, that absolute amount. So what is for whichever is lower. Firstly we need to see the cumulative gain or loss on the hedging instrument from inception of the hedge. So and cumulative change in fair value of the hedge items, present value of cumulative change in hedged expected future cash flow from inception. So we need to see cumulative gain or loss at starting itself and cumulative value or change at present value. So whatever the cash flows, future cash flows is there, now that future cash flows will be discounted. We need to see at the inception period the portion of the gain or loss on the hedge instrument that is determined to be an effective hedge, that is the portion that he is offset by change in cash flow hedge reserve calculated in accordance with shall be recognized in OCI. So when we recognize in OCI, we need to recognize it. If is there any remaining gain or loss on the hedge instrument, the balance change in cash flow hedge reserve. So in hedge reserve, if it is there in existing after the recognition, that is in accordance with A, that is cash flow, present value of cash flow. So and what is the amount which we are created hedge reserve. So the different amount, if it is there any amount, it will be recognized in profit and losses. So the amount has been accumulated in cash flow hedge reserve in accordance with A. Here first we need to identify that hedge forecast transaction subsequently results in the recognition of non-financial assets or non-financial assets. Here forecast means simply discounting the cash flows. Simply for financial assets and financial liability we will see. here non-financial asset, non-financial liability, and where has hedge forecast transactions for non-financial assets or non-financial liabilities becomes firm commitment for which fair value changing accounting will be applied. So if assets are non-financial or non-financial liability, then we will see that firm commitment and value hedge accounting applied, value of fair value of hedge accounting applied. Here the entity remove that amount from the cash flow hedge reserve and include it directly in the initial cost or other carrying amount of assets or liability. So if there is not reclassification items as defined in India AS 1, and hence it does not affect the OCI. So if it is not reclassification adjustment, it will not affect the OCI. So if it is reclassification items, it will affect the OCI, because some items we need to reclassify the into OCI. So we need to see whether it will have reclassification nature or not. For cash flow hedges other than covered, the amount shall be reclassified from cash flow hedge reserve to profit and loss, has reclassification adjustment in the same period or periods during which hedged expected future cash flows affects profit or loss. So for future cash flows, what is the interest income, what is the interest expenses recognized when forecast sales are occurs. However, some cases amount of loss, what is the loss and what is the expectation by the entity, and if that loss is not covered for one or more future period, so you are estimating some loss. So for that loss we need to does not have cash flows, proper cash flows, so losses will not be recovered in one or more future periods. So it shall immediately reclassify the amount that is not expected to recover into profit or loss as reclassification adjustment. So if you are not able to maintain, not able to bear this loss, we need to reclassify. So reclassify the items. Next, hedge of net investment in foreign operations. So if it is relating to foreign operations, here including hedge of monetary items that is accounted for as part of net investment shall be accounted for similar to cash flow. So hedge of net investment in foreign operations, only first portion of gain or loss on hedging instrument that is determined effective hedge. So we need to see that is effective hedge or ineffective hedge. If it is ineffective portion, it will be recognized in profit and loss. If it is effective portion, then gain or loss will be recognized in OCI, that is foreign currency reserve. So at that time of items only, instruments only, we are classified. If it is derivative, it has a return option, it will not come in the P&L, and all non-derivatives will come in the P&L except that currency risk and credit risk. So here they are discussing about that only. So if it is currency, it will be go transferred to OCI. The cumulative gain or loss on the hedging instrument relating to effective portion of the hedge that can be accumulated in the foreign currency translation reserve. So whatever amount we are writing now, it will be maintained in foreign currency translation reserve, and we need to reclassify from equity to P&L. So has reclassification adjustment on the disposal or partial disposal of foreign operations. This is relating to hedge accounting. I think we need to see the how we can classify. Disclosures will be there. So what are the disclosures? I think disclosure will be disclosure in next video.